Wealth management has been unnecessarily complicated for so long because the incumbents are trying to maximize their gains till the sun is shining. Historically, when people thought about wealth management, you would think of fancy offices, well-suited bankers, people not typically wearing t-shirts. I can't say that I can make wealth investing joyful, but I tell the team if we can take the stress out of it, we've played our role.
I totally agree with you that nobody is now excluded.
If platforms like us did not exist, you would still be paying $150 to execute a stock worth $100. The concept of wealth management was complex. The advice was sparse. The access was limited, and affordability was only limited to a few.
I believe inclusivity without affordability is bullshit.
We believe that if we empower the users with the right set of tools and right set of information, they would see why we are a much better option than any of the banks for their money. I always say the biggest competition for us is trust.
Hello, ladies and gentlemen, and welcome to today's episode of Couchonomics with Arjun. This is another one of those virtual ones. I do get a lot of feedback that I should do more in my studios, but if I'm getting great people to come onto the show, then I'll try and sort of balance this out. So joining me today, all the way from Singapore, is someone I actually met last year at Singapore Fintech Festival, and it's great to see that he's been able to make it in person. His name is Dhruv Arora. Dhruv is the founder and CEO of Syfe. And his team was very, very particular when they said, please call us a digital wealth management platform. And I guess with that, first I'm going to welcome Dhruv. Dhruv, welcome to the virtual couch.
Thanks so much for having me, Arjun.
Secondly, what does a digital wealth management platform mean?
Well, what it means is that it's not a robo-advisor. Let's start with that, right? But what it really means is that essentially a platform which is catered end-to-end digitally. A human touch is optional. It's available if you need. Some providers offer it, some don't. We offer it. But essentially, you could do the entire journey right from understanding the offering, onboarding on the platform, adding funds, having your portfolios managed, to withdrawing funds, and when you achieve your goals, etc., completely digitally. So there is no offline touch point required, but it's optional. If you need a physical touch point, it's there. And I think that is what we're trying to come, and that's what I would say is a digital wealth management platform.
Excellent. And we will get a little bit sort of deeper into this question because I do want to understand, what's the distinct difference between a robo and the platform you're suggesting. Obviously, I guess you've obviously shared this with me previously, but I think for the sake of the audience. But just for context setting, let's take this a few $1 trillion abstractions higher, right? I guess all of us read these very interesting reports. Some suggest that there's something in the region of 80 trillion dollars, which is going to shift from boomers to, I guess, the next generations within the next sort of 15 years, right? What does this mean? Is this a lot of hype? Is this a gold mine waiting to be sort of harvested? But more importantly, if I may sort of load this question, is how does the industry of yesterday, and apologies, I use that term because I think wealth management firmly for me has always felt like, wealth managers, private bankers, let's sort of stay away from these guys, is going to service the customers of tomorrow who are, different. Let's just put it that way. So in any case, a lot to unpack there, but I thought I'll throw the big question out first.
Yeah, I mean, I think it's quite interesting you mentioned about yesterday because that is true, right? I think historically when people thought about wealth management, you would think of fancy offices, well-suited bankers, people not typically wearing t-shirts. But at the end of the day, it was largely physical, and it was very expensive, and it was also limited in kind of the access that came around, and the advice varied person to person, right? I mean, wealth manager A would tell you something, wealth manager B would tell you something, but what was common was, and typically, let's say if these guys are associated with financial institution A or financial institution B, no matter, even if the financial institution A wealth manager thought that the institution B has a better product, they will still have to sell you what A has on the table, right? And I think this obviously leads to innate kind of biases in the offering. And eventually, no particular institution can do everything extremely well. So you're basically either limited in options or worse, taking options which are, multiple layers, fund of fund structures, etc. So the reality is that this so concept of wealth management was complex. The advice was sparse, the access was limited, and affordability was only limited to a few. And when I say limited to a few, the reality is even today, if you want to go and become a private banking customer for any of the well-known private banks, at 20, $30 million when you enter, they might let you in. Let's put it that way, right? You really can't enter the few $1 million. Now, I think what's been quite fascinating is that I think there's a generation which really enjoyed this. They like the white glove service and the F1 tickets and the free champagne. And then there is our generation, right, or this next generation, which is probably more feeling like, hang on a minute. So I'm paying 2% to essentially manage an SPY ETF. I mean, hang on, wait a minute. You have $20 million of my wealth. Let me do the maths. Basically, I'm paying you $400,000 a year just to manage something quite basic. In that, I can buy all my F1 tickets, I can buy flights, I can buy my own champagne and do everything else. And I think when you combine that with the shift of, and this is slightly away from wealth, but kind of still linked, so bear with the thought, of people actually being quite digitally native and digitally comfortable. Many of them do not want to speak to someone. They're just quite happy, whether you're ordering food or ordering, like, how many times do people strike a conversation with their, Uber or Careem driver and all? Not very often. I think the same thing is happening here. If I have a very basic standard kind of a need, which is frankly the majority of cases, I'm happy to self-serve at a fraction of the cost, where I'm not pressurized to buy this or sell or whatever, XYZ. But hey, if I need help, that can come in. And that is that kind of shift where the new generation is so comfortable to be digitally served and realizing, they feel a lot more empowered with this. And this is what we find very, very interesting. And the question, of course, is, will, the incumbents catch up to this, or will they serve the way they've served, but to this very, very elite kind of a segment? And I think that is, the opportunity to unpack and to answer your question in a line. We think the opportunity is absolutely huge, and it's not just from the rich; it's from that middle mass affluent segment first of all.
And so let's extend that thought a little further. So, are you suggesting? No, you're not suggesting. Let me suggest, and you answer that is: are these the big private sort of wealth players in the world, they're really not interested in that segment?
I think the numbers just don't add up.
Okay.
The reality is, most of my career was with UBS. It might sound great if someone has $20 million, $10, $20 million and the banks are making a few $100,000. By the time their servicing costs, legacy systems, fancy offices, space all go, they're still like, that's not a good customer. We've had banks who literally reached out to us and said, hey, can we send you all our customers who have less than $10 million, right? And how can you work with them? Because their overall cost of servicing is still quite high in these structures, right? And these numbers are only moving higher. So the reality is, they're not interested. They would, because they're trying to follow this 80-20 rule, right? 80% of their business is getting by 20% of the users. Let's go deep in these 20% users. That's what I'm saying. Today, if you go to the big popular American banks, at $10-20 million, you might just get an entry, but they might even say this is too little for us. And even at my time at UBS, that threshold just kept on increasing. So they are not, they're not wanting this, and they're focusing on, the higher segment, because the reality is they make much more money, much better ROI per time invested, hour invested on this side.
Okay. So that leads me to the next question, which is sort of, if I may say, the more sort of mass banks in the world, right? Which whether we like it or not, we all have a bank account, right? And most of us will have bank accounts with, I guess, let's call them the incumbent banks. Correct me if I'm wrong. Historically, these banks, or call them full service banks, let's call them that, rather than the private banks and so forth, have sort of always kind of missed the wealth moment, right? They've never ever, if I may say, captured the wealth opportunity. And I say this even before the digital era, because let's be honest, there was always the mass affluent segment. They would have loved to, they never reached the 20 million, 30 million cutoff, but they still had enough wealth, and there was large numbers of them. These guys had bank accounts, obviously. There was a point of interaction with the banks always, so the cost of customer acquisition is arguably lower. A number of these banks had some level of asset management capability. If they couldn't, they could easily go open architecture to third-party asset manager. Why have they, in the past, never really been able to seize the opportunity? And it sort of feels like that they won't be able to seize the opportunity going forward too. Why is this sort of, why are the two ships crossing each other in the middle of the night kind of story here?
Yeah, yeah. I mean, I'll answer that question, but maybe just to ponder on this discussion. Do you think the incumbent banks have captured the payments opportunity?
No, because it was incredibly transactional, right?
Yeah,
And some did who were able to sort of spin off their payments business separately,
yeah.
but no, they weren't. So most of them sort of sat by the
Sidelines,
sidelines,
right?
right?
Yeah,
Unless you're
and
talking
that
about
is
credit
what.
cards.
Yeah, exactly. But I'm saying like, but that is what led for businesses like Revolut and TransferWise and etc. to come up, and also infra providers like Stripe and so on and so forth. So I think fundamentally at the core of it, it's kind of the same thing, right? I think you're basically on a legacy infra, you're on a legacy framework, and you have this gigantic ship which you're trying to steer, right? And I think it always comes down to is can you actually maneuver it fast enough, as fast as the world is changing. And the reality is, in my view, some banks will be able to do it. I don't think no banks are able to do it, but I don't think majority of banks are really set up for that way. And the reality is, it also comes down from mindset, right? If you're going to have people who've never really built technology, I mean, these many of the people who've been or are at relatively senior positions in many institutions, they've built their careers rightly so on relationships and what was right in that wealth segment. Hey, I know him, but they were not really the technology first kind of approach, right? So then the challenge, of course, would be that I have something, it does really well, right? Should I be open to lose 80% of my margin and then invest all this in something new that I don't know with the future growth, where I'm technically still like a senior employee? You know, I it's a bit tricky. And I don't think everyone has that mindset. And you see exceptions, right? Like a good example I would say is take DBS here, and what Piyush Gupta did with it. It's fantastic. Like this bank, people always think it was a number one bank in Singapore, and it was basically, you go back 10-15 years, it was like number three, number four, but just digitalized the whole bank, got them on pace, and got them on their offerings. But specific to wealth, I think it's obviously going to be, you work in a particular way, you've built up in a particular way, and at that scale and size, it's much more than just four people meeting in a room and say, hey, let's build something new. And that's where they'll struggle. You've seen banks try to replicate payment apps and build separate Wise beaters, Revolut beaters, and all. They've had the same kind of a challenge. So I think it's a little bit of legacy, a little bit of mindset, and above all, just the sheer size of the business, which makes it very difficult to change. So I reckon this will carry on in the future as well.
So I'm going to carry on with this thought a little bit more, and I think that there's a little bit of sort of peeling the onion, and I think this is where you also see that I think there's a separation between sort of payments and wealth, right? Firstly, it'll be incredibly helpful. Let's deconstruct wealth a little bit, because I think a lot of people don't they see the wealth side, the advisory side of it, but there's the whole asset management side of it, there's the custody side of it, there's the technology side of it, right? And all of this has to sort of come together for anyone to be able to offer a compelling wealth proposition, right? Wealth/investment proposition. The second element here is, and this is where I still think that the banks, I personally think, still miss the point, is there is an element of trust here also, because there's a sizable amount of your lifetime savings or a significant amount of your income which is going into these vehicles. Payments is transactional, right? You make a payment, you buy an ice cream. That doesn't work. You go to the next one. You go to the next one. There's that difference. So two-part question. One is kind of deconstruct wealth for us a little bit in terms of what are the component parts and why all of this is very, very important. And secondly, for players like you who are sort of coming into the market, who don't have the halo effect, right? Who don't have the bank's name behind you, right? How do you overcome that sort of trust and faith angle, right? Saying, put your lifetime saving or put a significant amount of your money into our vehicles, right? Or into our apps or whatever you want to call them. So how do you tackle that? So two-part question.
Sure. So, wealth, of course, absolutely correct. Said it's got multiple aspects, right? I mean, you have everything from, asset managers who basically create fund or fund kind of products. You have brokerages who are like self-directed, buying and selling. You have basically API providers who help you connect with, brokerages. You have obviously the exchanges where you buy and sell stocks. You have infra players who help you connect with these exchanges. You have then the banking partners where money is flowing. Of course, now the whole wave is moving towards stable coin, which is probably still some time out in this domain. But again, eventually you have everything from, everywhere the flow of money, from a user's, typically from his bank account, coming to, like in our case, let's say a wealth manager, and then, that flow via API rails going to, through an intermediary to the exchange to buy some things, then that coming down, then that getting custodized, at a safe place, and the customer has a safe in should something happen to us. That there are obviously a lot of players out here, right? But for the sake, I think at least where we come in, we are probably, I would say, from a user perspective, a combination of an asset manager plus a brokerage plus a custodian, right? So because they just interface us, so they don't have to interface like 5 or 6 counterparties, so as to speak. So I think a lot of players out there, but of course, what we are trying to come is that, hey, you come to us, and this term that we use is holistic one-stop shop, right? One place where you can manage your money across market cycles, and happy to dive into it, right? So I think that was the first view of around where the wealth is, right? The second part is exactly what you said, right? When people ask like, hey, what is your biggest competition? Is your biggest competition the banks and all that? And I always say the biggest competition for us is trust, because we are dealing here with financial institutions which have been built around for decades, if not more. But the reality is that a lot of people still understand that if a bank does go down, you don't get your money back, right? You only get your X amount of protected capital back, so on and so forth. So the thing is that that trust that has been built over decades, I would say that is the number one so-called competition. I mean, of course, I call it inertia from users, but it's coming from basically this aspect of trust, right? So you're right, and it's hard, yeah. I mean, Arjun, when we started, like our highest tier at Syfe was $10,000, right? Startup just started. Who's going to give us $10,000? Then somebody gave us 20,000. Then we're like, okay, let's move the needle. Let's make the limit as 50,000. Then someone gave us 75,000, and this is all in the first month. And I remember going around the office, like maybe a small co-working office, and you're like, guys, is someone's reference? Like, who's this guy? We've never heard this person's name. And I was like, we don't know him. Spoke him. He's like, no, interesting product. Happy to give you money. And over time, we just kept on adding. And today our highest tier is $5 million. And we have multiple clients who have now given us north of $10 million individually, right? Individually parked money. They're not talking of corporates or family offices, just individuals, right? So I think firstly, trust, it compounds like for any business, right? I think on our side, what we've always focused on is a lot of transparency. I think when users see that and they compare it with historically how they've been served, I think that really helps. Like literally on the app, okay, these are going to be your costs. This is what you're going to incur. This is what it's going to take to withdraw. You can do that. So I think one was that. I think secondly, what we did was we really fractionalized everything. We built our own backend. Like people fractionalize US stocks, but we fractionalized REITs in Singapore. So basically, someone who has $1 million or someone who has $10 is getting the same product. Now, not that $10 is good for us. I mean, we obviously want the $1 million client, like any business. But the fact is, what behavior we started seeing was people would give us like $10,000, withdraw $1,000 because they can, because it's not locked up, and I can do any sizes, and then give us $100,000. So you remove that threshold of entry in some ways, and sometimes it's not the people can afford the money, but you want to dip your toes in before you go all in, right? Something of that sort. So I think that was the second part. And I think the third part that actually really worked a lot for us, which we're still continuing, is a very heavy focus on content and education. Because at the end of the day, we believe that if we empower the users with the right set of tools and right set of information, they would see why we are a much better option than any of the banks for their money. And this is what has been working, right? I mean, when we started like 6 years ago, we was zero. Today, we managed north of $10 billion, right? And it's all coming from like, retail. Of course, there might be some accredited, but it's all like individual, wealth so as to come in. So I think it's a little build up, and you have to keep on repeating the same message. Of course, there is product innovation, and you build something unique and people like it and it attracts them. But the fundamental essence of it is that, look, you got to be transparent. You got to go with the consumer first kind of mindset. You got to focus on education and lastly remove the barriers at every point, whether it's entry, exit, so on and so forth. I think those are some of the things that has really helped us get to where we are today.
So I'm going to ask the obvious question. Well, firstly, congratulations. You had a significantly large raised. I think it was $80 million, if I'm not
Yeah,
wrong.
CDC, that's right.
Right.
Yeah,
And
yeah.
also, you've acquired a company down in Australia, right? I guess twofold questions. Where are you going to use the money except buying yourself a yacht? And but no, serious questions. How do you
Yeah,
intend to sort of deploy the money? And
with
secondly,
the capital.
talk to us a little bit about this expansion into Australia through an acquisition.
Yeah, yeah. So, I mean, the good thing is that, like, the capital part of it, of course, had gone to fund the acquisition. But I think the primary focus of it is going to be around growth capital. I think one thing that we changed quite early in the journey of the business is this trip I made to the US in early 22, and this market turning days of free capital, it became super evident it's happening. So we actually pivoted quite strongly, not as a business model, but pivoted from we were never grow at all costs, I think, but we were, let's grow at high costs. We moved to basically this sustainable kind of growth model. So our core business, actually, an underlying business, is actually profitable from last year. So any new capital is basically asked to keep and grow. So what we really want to do is essentially deploy this capital into growing Australia. And the other market, which actually, finally, I would say for us has been seeing some really solid traction, has been Hong Kong. China has been a little bit of on a rough journey, but I mean, in the last year, actually, the market has done really well. So our Hong Kong, business has doubled in the last 6 months, right? So we took 2.5 years to get to a certain stage and 6 months to double that up, right? So a lot of the capital will largely go in growth in these two markets. We won't be needing all of it, but a part of it. But at the end of the day, as opportunities come by, as a probably not immediately, but down the road, we might consider other acquisitions also. But currently, the focus would be on these three markets. How do we grow the business? How do we double down on Singapore? I mean, our core like business is profitable, so you can reinvest that capital. But a little buffer, as we are trying to grow into Australia and Hong Kong, I think that's probably going to be where the primary use is going to be. So that's about where the money is going to go. Now, about expansion via acquisition, that's an interesting one, right? So I think the first thing for us was we prioritize markets over so-called, I mean, just because an attractive target doesn't mean that we'll do a market, right? And I think for us, we were very clear we are going after mass affluent segment. Now, how we define mass affluent is, people who have anything between few $100,000 to a few $1 million of investable assets, right? With a clear premise that basically, you have some money, but not enough money to get the private banking kind of service, which over time I hope people will get lesser enchanted by, but currently they still get enchanted by. And this segment can't get catered, as you said, you won't be allowed in some of these private banks. So this is a segment, and then where can you find these kind of users? And when you look at the numbers in Hong Kong and in Singapore, 1 out of 2 adults fall in this segment. In Australia, it's actually 3 out of 5. So it became quite an obvious choice that this is going to be the next market we want to go. Now, we were trying to actually, grow that market organically. We had soft launched and we tried. But then we said, look, building this business in Singapore over the years has taught us that, you can't really, just take a business, oh, it works, let me copy paste it here and, build and they will come. I don't think it builds in, wealth. And again, comes back to that thing, right, where the education you need to do in Australia is probably a bit different to the education you need to do in a place like Singapore. The products you launch in Australia are a bit different to the products you want to launch in Singapore. So I think keeping that in mind, we were fortunately in a spot that we could afford to acquire a business and, get, I would say more than a foot, maybe get a leg in the door, so as to speak. And again, it's a fantastic business, right? It's been around for 13 years, really, loyal customer base, and a very similar, thesis of long-term wealth and mass affluent segment. So I think for us, that was an entry point, but we are here to grow the business, right? And with this, at least, now we have 2 very big markets now, both in, Singapore and Australia with multi-billion in assets each. And then, of course, I mentioned about Hong Kong growing and all. So I think that was the broader thesis, and that's how we went about thinking the market and then the target.
And I hear you, and I think you've done well by actually sort of staying focused. And again, I totally appreciate every market is very, very different, and or different enough in the sense that the way the consumers behave, the way they consume education, the way they actually interact with digital platforms, so on and so forth. But if I was to ask you this really sort of, I guess, unreasonable question, if I may, is there one thing that you must get right, irrespective of which market you're in, and which is what makes Syfe what Syfe is today? What is that one thing? And I'm sorry, I'm being unreasonable.
Yeah. I mean, look, yeah, I mean, the thing is, we all sometimes people ask, oh, what has been the silver bullet of the business? And I always try to say, like, look, there is no silver bullet. There are a lot of, small silver bullets coming together and all that. But I think one thing which you cannot do, or at least we can't do, is ignore, okay, in a negative way, ignore what the local market and local users need. In a positive way, I would probably say a blend of localization and personalization. I think that is one thing in wealth you can't, which is very different to payments, right? As you correctly said earlier, payments is very transactional. You build a platform, unless leaving maybe some language edits, it's all like same, send money here, send money there, all that. But wealth is very, very different. Yeah, what the pension offering is called here is very different to the pension offering in other markets. The capital gains taxes are very different in Singapore versus Australia, and so on and so forth. So I would say one thing you absolutely you can't do without, or you have to get right, is that localization, right? And I think what we say our model is what we say local, right? I mean, 70% global, but 30% local. And when we even look what has worked for us in Hong Kong, what has worked for us in Singapore, for example, it's always some of these local products which we spend time, and having our own investment team and doing it all in-house, etc., gives us that advantage versus just blindfoldedly partnering with the next provider of products, where you don't build a moat for yourself, right? And I think that's perhaps what
No, and
we've
that's a
done well.
fair enough answer. I guess it is. Let me dwell into that. We talked about Robo for a while, but before I get into Robo, if I'm a customer, I download the Syfe app, I open it. What all can I do on Syfe?
Yeah, so it's a great question. So we primarily have three verticals as the business. The first vertical is brokerage, self-directed, buying and selling. We've made it super easy, very simple, fractionalized, round the clock trading, all the bells and whistles. But target again at long-term wealth, and can touch on that a bit later. What I mean by that. The second vertical is managed portfolios. Now we have our own, pretty strong investment team, ex-bankers from the big, private banks like Goldman Sachs and all that, PhDs, quants, etc. We build, model portfolios for our users, which are targeting a specific, use case. For example, global equity exposure, China exposure, passive income. I want higher, yielding products, real estate exposure, ESG, etc., as the case might be, right? So there essentially, these are more for if you want a more of a curated solution where one click and you're kind of done, kind of thing, right? And the last one is cash management, where we offer better than bank products, better than bank, interest-bearing products, which could be as simple as, perhaps the best fixed deposit product in both Singapore and in Hong Kong, where we have the offering, or also something like a money market fund, which can just give you some higher yield for the money, you have on the side. You might need it, but you unlock it. So the premise is that with this gamut, what we actually cover is quite interesting. And this comes back to that holistic wealth thing. If you know what you want to do, there's brokerage. If you don't know what you want to do but need help, there is managed portfolios. And if you're like, look, it's all jittery, Trump keeps on doing these 180 turns and all, I just want a higher yield on my cash balances, there's a cash management. And what this has in Arjun is that across market cycles, across personal cycles, which actually people don't talk about enough, like people have their own motions, I'm having a new child, I'm moving house, I'm buying a house, you kind of have no real reason to leave the ecosystem, right? The only reason you will leave the ecosystem is if you really, really genuinely need the money, because even if you're going to withdraw to the bank, you're probably going to get 5 basis points here in Singapore. We're going to give you 2.5%, right? So I think those are the three kind of primary verticals, which we currently offer on the app. And recently, and this is more, I would say, for us on an experimental basis, we've launched a private credit, right, where we are now giving users, like, if they want to take a slightly higher risk and with a longer duration, they can go for higher kind of yielding products, because fixed income is back, right? So we obviously keep on innovating, but the premise is that across these three cases, you cover 95% of the use cases of this mass affluent user, right, so as to speak.
Okay, and how deeply built are you as a business, right? Because a lot of players in your space, with all due respect, were just very flimsy wrappers at the
Yeah,
top, which said the same
yeah,
three
yeah,
things to me, right? But
yeah,
as you went deeper, there was, they were completely dependent on third-party brokerage platforms. They didn't have any fund
yeah,
management capability themselves. They couldn't build these portfolios. They
yeah.
couldn't even dream of having asset management. So, how deeply built are you as a business?
Super deep, and I would just say that because 2 out of 3 people at Syfe, they work in product and tech. For the first year and a half, we were just building the backend. Essentially, we build this system which internally we call FMS, which basically can fractionalize anything. So we were fractionalizing, global equities, not just US equities, as we're doing from 2019. You can put any asset class, and we can. And this comes back to building that portfolio and letting people buy $1,000 and when or $1 million and have the same kind of outcome. So all our tech is built in house. All our tech is proprietary. Of course, in some cases like market data and all that, we will go and work with different partners and all that. But I would say the way how we've always thought is that the core systems need to be all built in house. And in certain cases where it makes sense in the short run, you work with third parties like everyone does, right? I mean, what is this? Wasn't Apple like what Uber was using Google Maps or whatever the case might be? And at some point, you say, look, it makes sense at some point, to move it massive, which is quite a standard journey. And I think both sides expect it, but very deeply built because eventually that is our mode,
And that
right?
I was gonna
Yeah,
ask you.
that is the only mode. That is the only mode. I always say like people say, well, what's our only mode? So I always say like, look, it's speed. And I actually believe if you have your own tech and if you have your own stack, you actually have in the long run much higher speed. So of course the decision what you do yourself and what you do, but every time and then when we are building things, we are building immensely in-house. And sometimes our partners are surprised how much we've built in-house. Now we work with some of the bigger financial institutions. We are actually literally they like to work with us because when they build things with us, then they're going to sell it off to other people, right? So as to speak. But no, it has to be, and this has to continue because eventually if you're just a rapper, then anyone can build a rapper, right?
And that's the whole point. So let me come to the middle vertical that you talked about, right? If I was to be a guessing man, and I'm by no stretch of imagination an expert in your sector, that sounds a little bit like Robo, right? Right. So is that,
How's it different from
yeah,
Robo?
is the middle one? So I understand you're completely different from the front end from a Robo because you're offering three, and now you said you're starting to offer private credit, which and maybe that'll go into alternatives, or alternative sits under
Yeah,
as an
yeah, yeah.
asset class.
Yeah,
How's your middle bit different
yeah,
than
different.
a
Yeah.
classical Robo
So
player?
no, happy to answer, right? So I think a classical like robo-advisor is, for them, people think it's like a robot, and somebody's like, just you put something in and they'll just shoot out, algos running every day, and they're shooting out answers to do. And I think when we started, I think we got kind of bucketed, and we had to do a conscious effort to move away. We're not that, right? I think how we do in this middle segment is that firstly, there is obviously a lot of it's almost like a goal based approach rather than a robo kind of based approach. And what I mean by that is that I would say this is more like a rule based investing, more like I would say, remove the kind of emotion out of the thing, but more like, a logic based, and happy to go deeper. Like we call it factors on our side and all that, like, like whether you go long, long wall, short wall, you go mid cap, large cap, etc. So we basically decide factors and we decide bands. And what we do is we basically then back test it and then obviously run forward looking simulations. And essentially what we do is what it would be probably closer to is more like a quant model of investing, vis-a-vis saying that we are going to beat the market, right? We say our three pillars in the business are access, advice, and affordability, but I'm very conscious we are not here generating alpha. We might generate alpha by saving costs and all that, but the reality is, and I'll be very open about it, if I was really an alpha generation play, I would not be doing it for 50 basis points, right? I'll launch a 220 hedge fund, right? So I think the segment we're getting, like, look, if you want to beat the market consistently, then try our brokerage, try it yourself, right? In some ways. And one very fascinating thing is that what we've observed is that people who've been, and obviously many users are now on both these verticals, people actually who are actually, and maybe not a surprise to you, but people who are actually more active end up actually underperforming those who are a bit more passive. So we've actually found that generally women investors on our platform end up doing better than men investors, right? and it's just because they are quite like, passive. They'll buy, forget, or come in a managed portfolio and forget. But as guys, we always believe we can.
Well, I don't. I can tell you from my own example because I'm old enough to have actually sampled it on myself. But
Absolutely
yeah,
yourself.
right.
There
Well,
you go.
whenever I try and think
Maybe
that,
it's with that journey.
yeah, whenever I think I'm being too active, I usually land up losing a lot more money.
Yeah,
If
exactly.
I'm
So I think that's the point. So I would say more like a rule based, investing, where we are not having a so-called investment person waking up in the morning and say, "Oh, I think we should sell China," right? Which some of the other players, do, and they think they have this great CIO and they can beat the market. But no, if you're doing it, don't do it for 50 basis points, right? Launch a fund. Don't play with retail money. Launch a 220, long money or hedge fund or whatever you want to do.
okay. So here's the question, right? So 10 years ago, the Robin Hoods of the world came out, and maybe it's a bit longer, but whatever, right? So about a decade ago, there was this whole conversation around we're going to democratize access to wealth management or wealth, right? And that was going to come through these digital brokerage trading apps, uh, including fractionalizing, right, which would allow people entry, and then Robo was another part of it, which was saying that some people who feel vulnerable can get some advice because they can't afford the advice otherwise. Fast forward 10 years, have we really democratized access?
You know, the short answer I would say is yes. And I would say yes because at the end of the day, the threshold for entry, right? Like if you go back 5 years, you could not even onboard digitally, right? You had to go and send paper form somewhere, and then obviously your signature did not match. So, then you have to do the whole process again and so on and so, and then pay 150 entry and all that stuff. So at the end of the day, the two parts of it. I think with the new age platforms, the threshold for entry has really become very low. And the second thing, which a lot of people don't, sometimes talk about, is this inertia. And not trying to, be sexist about this, but at the end of the day, what we've had a lot of our women clients come and tell, look, historically, I would just have to speak to my husband about how to manage money because I don't feel I'm, empowered enough or smart enough and all that. But here I can do with some small thing on my own CR because actually I quite like it. And then they kind of build for it. So I absolutely think there has been that democratization where at least there is no one who is eliminated right now, right? Before you had to know someone, go get in a line or whatever to get this part. The second part, which actually, I feel we don't talk about enough, is what platforms like us, and this is in payments or in insurance or whatever, what this does to the incumbents. If platforms like us did not exist, you would still be paying $150 to execute a stock worth $100, right? And I think that's a very important point. The reason, because of platforms that exist, the others at least are like, okay, look, we can't do daylight robbery. We can't charge you $150 for a stock execution. Maybe we'll charge you 25, right? And they still do that and all that, right? So I would say that that's also an aspect to consider. So even for their segment who might be still building trust or not ready to come to Syfe, even for them, you've basically widened the number of people who can access it. And this democratization is happening, obviously through apps and solutions, but also with the sheer amount of information available online, right? So a lot of people, I feel are a lot more empowered today, right? In some ways. So you can argue some of them, get up in the meme stock frenzy and all, separate debate. But the access, 100%. There are a lot more people today than they ever were. And that number will only grow in my view, right? Because I think fast forward a decade from now, or even earlier, in my view, investing and saving will be one. Saving is going to be my low risk investing, right? Essentially.
Well, I think it's excellent because you've given me sort of the segue into two of my questions. But before I end, I think, and give me a snappy response in that. I totally agree with you that nobody is now excluded. I like that sentence, right? So if you have the ways about you, right, or the wit about you, there are platforms that you can access. Also, I believe inclusivity without affordability is bullshit. And you've said that things are a lot more affordable too, right? And so there's affordability, and then there is access. What do we need to do to really turn up the level of engagement? So let's put it this way, right? So it's not the people are not, they have the option of being democratized. It's not being democratized to the level of potential. So is there a magic bullet out there? Is it two or three things that we need to do? Does the regulator need to do something about it to really amp this up?
Yeah. Solid question, right? I think regulators, at least, I feel here in Singapore, have been quite forward looking. I think some of the other regional regulators, there could be some room where they could find a right balance, right? About, because they're doing the right thing. They want to safeguard, obviously users and all that stuff. So I think that's one thing. But look, it's always that's a chicken and egg debate, right? So I'll talk about that. I think if you realize, like, to fundamentally, like, and I can't say it's a magic bullet, but basically what I envision this will really, really get amped up is when you have a platform that is really good on the technology front, actually being able to genuinely join hands with someone who's got the thing what they don't have, which is trust and distribution, right? So if you ask me, when a real big bank, ends up partnering with this and then genuinely is willing to, almost sabotage their present for an inevitable future, and you see it, you look at a very parallel line like telcos industries, right, where they sabotaged calling prices because the action was all happening in data, right? And they basically, so you sabotage one industry, but that shift was inevitable because nobody was calling, everyone was using WhatsApp, right? So I have to start pricing, this thing. So I think the day we can have where, some of these two come together, I think that is where, and at scale, I think that is where you will see the amp up. But otherwise, look, I think it's going to be a slow growth in some ways. Well, I take the background slow growth. It'll be an accelerating growth, which keeps on getting more and more, prevalent. I think right now a lot of people have still probably been attracted by the wealth generation potential, or I can make 10x returns and all that stuff. But I think that long-term wealth, eventually through few market cycles, people make some money, as you're talking about, lose some money, and then realize, actually, I should be long-term wealth. And I think that'll eventually happen.
Okay. No, I get it. I think that whole trust factor is important. I think incumbents have a role to play, and I totally agree. 2-3 questions left. I'm conscious of time, right? You brought out, you brought meme coins. Let me bring the bigger sort of digital assets crypto piece, right? So we have this proliferation of exchanges coming up, centralized, decentralized, which are also offering people the ability to trade in the crypto world, right? I fundamentally believe that both of these will merge, because at the end of the day, the crypto is, for me, is nothing else but the next generation of technology within the world of fintech. And I don't understand why we get so carried away and we're trying to create these two different worlds, because I don't think it's two worlds. It's okay, it's a leap of technology, which is further than incremental. But at the end of the day, that's one. That's my rant. Let's get my rant out of the way. How do you see the future playing out? Is this going to be a divided world, or are people going to gravitate to platforms which are going to give holistic solutions across both the crypto and non-crypto world?
Yeah.
Right.
Like holistic, yeah, has to be. Yeah, I think I make just to give an analogy, right? Like, if you go back 50 years, you need to know every nook and corner of your car, right? Because cars would break down all the time, right? Today, for all practical purposes, we're already living in an autonomous world. You book a cab, you sit, you never speak to a cab driver. For all practical, Uber is an autonomous car. Of course, you can have autonomous car. So the view that we've always held, and we said day one, is that this wealth management has been unnecessarily complicated for so long, because the incumbents are trying to maximize their gains till the sun is shining, right? But eventually, it has to get completely commoditized. Eventually, the end platform is going to be, salary is going to come. It's going to come in a platform. It's going to get allocated, to an, based on this individual's personal preferences and all that stuff. And then whether it's crypto, non-crypto, does not matter. I agree with you. In some shape and form, as for all practical purposes, today Bitcoin is like gold ETF or something, right, or whatever you want to call it, right? So yeah, so I think it's going to be one. It's going to be one platform. And what I do hope to happen, the one difference I do hope to happen, is that I think there'll be some practical use cases of this emerge, which currently is still a bit limited, right? Like today, we are still, these coins and all are getting traded more as assets and collectible watches, or whatever you want to call them, right? Like all these meme coins and all those. I forgot those board apes and all that stuff you had, but eventually you'll have this practical use cases of it, and I think that becomes quite interesting, right? And of course, there's a lot of chatter recently about the whole Circle IPO and how stable coins can solve some of the cross-country remittances and all that I feel will happen, but all the players need to come on board. So it might not happen 1-2 years, but over the next.
What does that mean for Syfe, right? So because you have these exchanges coming up which are offering crypto, right? Decentralized and centralized. There's players like you already. Then you actually, to make topics more interesting, there's the rise of the alternatives, and I don't mean just private equity and VC funds, but I also mean all these exotic, wine investment and cars and whatever else, right? You can merchandises and stuff like that, and they're actually building platforms themselves, which are direct to customer platforms. Like I have a startup which approached me very recently saying, hey, we're entering the Middle East, can we get you on your advisory board? And I'm like, mate, what are you talking to me about for? I don't even know where to start with all this stuff. But what do you do then? Do you need to go acquire all these companies then to sort of integrate with Syfe, or do you just build out?
Yeah, the thing is this, right? In my view, like this comes back to the economics basics of supply and demand, right? And I actually, like, I've always maintained this. I think what becomes really important is to have the consumer, right? Because you have to realize, like today, every asset manager wants to work with us, because eventually, what am I doing? I can't make their business worse. I'm only going to make it better. So I actually feel platforms which eventually have the user will have the highest probability of success, because eventually anyone else who has a service, whether it's a wine collection or whatever, they want to distribute. And it's no different than, as you said, in Middle East, somebody's trying with the B2C approach. Oh, actually, this is quite tough. Let me do B2B. We're going to be other B of it, right? You see what I mean? So in my view, like I think having the user on your platform and them being strong as that, hey, you're there. Now, of course, the onus is on our platform to keep the user there, where we also then have to be on top, right? If I was living under a rock and just had this kind of robo-advice model and did not change the business and evolve with the times, I don't think we'll be where we were today,
And you don't think
right?
customers want to stick to, so Arjun doesn't want to go to Syfe when he wants to buy, ETFs and Nvidia or whatever else, and then he prefers to go to crypto.com if he wants to buy, I don't know, Ethereum and
I
Solana.
mean, look, Arjun might have a lot of time, which I don't, which I know is not true. But over time, right, over time, what will happen is that, look, unless, as I said, there would be some niche cases, and they're always there, right? Like I'm a connoisseur and all that stuff. Sure, I still say, right, like taking my car example, right? There are connoisseurs who still drive 1980 cars, right, and they are happy to tweak the engine and do a little rev and all that. But for most people, this is going to be commoditized. For most people,
Okay.
I strongly believe they don't enjoy managing wealth, right? And I always say, like, look, I don't, at Saif, I can't say that I can make wealth investing joyful, but I tell the team, if we can take the stress out of it, we've played our role. And I think for majority of us, that's the segment case. They're aficionados, welcome, please go to the platforms. But to actually fundamentally change that, investing, wealth, saving, don't worry about it, focus on what you do for a living. That's the game you want to play.
I've got two more questions. I know we have 5 more minutes. Here's the last one. And I think this is where I think making things easy is a lot easier. You talked about the coupling of savings and investments. I don't know if you use the same very words, but I think you alluded to that,
Yeah.
right? I fundamentally believe that I think that coupling is essential, right? Domestic household savings are declining, especially interest rates are not that attractive and they're volatile. People don't really want to save. I think banks don't give interesting products in terms of attracting people to savings. If the industries, the two parts of the industries were to come together in terms of the industry and the saving side and the investment side, I do think more and more money would flow into,
Yeah.
if I may say, pedestrian, boring saving products, but because people would get some returns on them, right?
Yeah.
Why don't we see more and more of it?
So it's actually quite interesting. You are seeing a decent uptake, right? Like when we launched our cash management product, right? For a company of our scale, just small, we had $1 billion in this product in the first six
Okay.
months, just here in Singapore, right? So people are seeing this, right? I think the point you mentioned was interest rates. I think interest rates had remained high. I think sort of continued. I think now they've come off. People have a high benchmark. People have short term memory, right? They remember the four, five. They remember the 6% on USD or whatever, 5.5%. They don't remember the 0% we had for a decade before. But eventually, for a lot of people, especially like either it's first time investors or passive investors, the first port of call will be a higher leading cash product, right? And I think that becomes the new kind of saving. So our current saving is a poor investment product, is the way how we describe it. So the first port of call becomes this better so-called saving, we call it like smart save, etc. on our side, kind of an offering, which eventually, as people mature and as they grow and life cycle changes and they have bonuses or they have, they feel like they're more stable and all, eventually gets channeled into different parts and all. But given the world we are entering, like investing, in my view, is no longer is a nice thing to do. It's not a choice. It's you have to do it because people are going to live for much longer, and by choice or by circumstances, and I believe more by circumstances, their careers would be ending up much earlier. So that gap between when your so-called earning potential stops and your lifespan, that gap in my view is increasing. So unless you start investing into that and saving up, I really think we're going to have a very different future. Yeah.
What's
Yep.
next for Saif? Are we going to see you guys in the Middle East? That's not the loaded question. I'm just saying. So first, generally, what's next for Saif, and are we going to see you here in the Middle East?
So, given the acquisition and the fundraise, I think for the next 12 to 18 months, sort of focus would be in the three markets. We would want to go deeper, right? We'd rather build a great business in three markets than, be in 45 countries with periphery. And I believe in wealth, you need to go deep, right? So as to speak. The other developed, whether it's North Asia markets like Japan and of course, MENA and all are very, very attractive. I think for some of these markets, our premise would probably still be to work with someone, probably more work with an incumbent if possible, and if shall they be open to it. But that B2B2C kind of route is probably going to be our primary kind of go-to. Of course, opportunistically, if there are opportunities around acquisition, etc., we will consider. But I think, probably hands are quite full right now with all the developments recently, and we want to do it right, rather than
and you're in the
just
right side of the world,
what next
so
kind of thing.
there's tremendous opportunities, right? We didn't even talk about markets like Indonesia and others, right, where there is tremendous opportunity in terms of just small percentage of people but a huge number, right? So it does work. Dhruv, thanks a lot. I'm sure we will meet. Well, I'm not sure, but hopefully I will get to meet you at Singapore in November. I do plan to come. I think it's the 10th anniversary this year of the Singapore FinTech Festival. And guess what? I think I've achieved another goal, which I've been trying to set myself on each of these episodes. Is we didn't talk about AI.
I was wondering at what point are you going to bring it up,
Yeah.
right? I'm like, man, I'm sure you've heard enough about
I
it,
personally
right?
didn't think we really needed to, because I do think that a lot of people just, you could just Google AI and wealth management. There are 20 reports there. So no,
I know, I was just gonna
I
say, it
purposely.
makes me cringe a little each time I have to use that word. I'm like, look, we are using it? Yes, we are definitely using it. We're using Cursor, Midjourney, digital advice, of course, but it's
Yeah.
too cringe now. So.
Yeah, I didn't want to ask the obvious question, right? And then get nothing. No, I thoroughly enjoyed it. I actually learned a few things myself, which is basically my ulterior motive behind this podcast. It's all very selfish. But no, thanks a lot for taking out time. Have a good day. Have a good week, and best of luck with whatever you're trying to do, and kudos to you and the team. Well done.
Thank you so much. Thanks for the conversation, and yeah, look forward to seeing in person in either in Dubai or in Singapore. Yeah. So,
Yep. Wherever, whoever comes to that part of the world first, right? All right. Cheers.
Arjun.
Ladies and gentlemen, that was Dhruv Arora, who is the CEO and founder of Syfe. I think it was a thoroughly interesting discussion. I think we covered a lot of ground. I know we overran our time limit a bit, but I guess, the conversation was interesting and you'll stay with us. So with that, I'll say goodbye and see you next week. Bye-bye.